Hey there, it's Adam Shea, CPA. Hope all is well. Unfortunately, this is the third week in a row where I've had Friday conflicts. This one's a planned short little trip to the mountains. Prior to that, the last 2 weeks, my son's baseball all-star team has had state tournaments and tournaments here in North Carolina. Look forward to joining you all in person in the near future. Anyways, today I did want to at least take the time to do a little recorded session, talk a little bit about C corporations, little background and information on C corps, and then get into a couple of the technical details and nuances with them. Anyways, so when do you typically see a C corporation? You sometimes have a legacy corporation where just people have never made the S election. We occasionally see that. They also can be attractive for when companies have external investors, and those external investors don't want the income flow through at the personal level. So you see that, and there's sometimes some qualified small business stock exclusions on capital gains there that are also attractive to investors, assuming they meet criteria. Um, Sometimes people are a C corporation just because they don't know any better. They incorporated, they never made an S selection, they didn't do anything else there. Um, in that instance, like, you may not always assume, even though they come to you and show you that they're a C corp, should they actually file as a C corp? Maybe, maybe not. May make more sense for them to do a retroactive late S corporation election with their S corporation election filing. Um, and then finally, here now, you may start to see and hear more about C corporations due to tax reform. So they highlighted the lower C corporation rate at 21%, regardless of whether it's a professional service corporation or not, has people looking at C corporations thinking they should be C corporations. Um, in our experience, we've done some analysis for some people, and not as it doesn't make sense for as many people as they may think to make that C corporation or switch to a C corporation or elect to become or be taxed as a C corporation. Just because under the C corporation you have the double taxation with dividends or distributions, and a lot of times, unless people are leaving money in their C corporation, it just doesn't work out too advantageously for them. They also have to be careful if they are keeping money in the C corporation, that they do not keep too much in there in excess and then be subject to an excess retained earnings tax assessment by the IRS. So that's just one thing to look at, or at least be aware of. Um, the other thing is you just need to watch out for that. You need to watch out for dividends. If owners are taking them, were they truly dividends? Does the bookkeeper think it makes no difference, just like it would under an S corporation, and just classifying anything they don't know or looks to be personal as a dividend? We've seen that happen, and so it makes a bigger difference in the C corporation versus S corporation. Obviously, overall, it makes a difference as they're not getting a deduction when they should, if it's classified as a personal expense versus a business expense. Anyway, so that's just kind of a high level, quick overview of them. Have an example here from our first pass, I believe, of the tax course that I just wanted to walk through. So here's a Startup Technologies Inc. Profit and loss. Goes through with their P&L. Let's assume they started January 1 of 2017 and not 15. So I'll run through and show you. I've already got the data entered here on the P&L. And I'll show you also considerations regarding the balance sheet. Their balance sheet is pretty simple. So, you have your checking account here. You have some assets. They haven't recorded any depreciation yet. You have capital stock. First thing I look at, and I will note, like, when I get the balance sheet and P&L from, say, QuickBooks, I like to get the Excel version and not the PDF version, just easier to manipulate and tie out that way. This client's a pain in my butt, so they did not do that for us. So we're stuck with the PDF version. So let's go with that. One thing you also want to look at is, are you looking at accrual financials or cash financials? How are they treated from a tax return basis? So we're going to assume for this example they are accrual and we have the right set of books here, and see how that all plays out. So have our basic information in here. Let me just change this to Startup Technologies Inc. Want to back some things out here. Probably spent a little bit more time on the front end prepping for this than maybe I should have, or that'll just I want to start and highlight a couple things and work through it with you. So if I go into view mode here within Drake, you'll see I have, it's kind of hard to show both at the same time, but let's see if I can do this where you can kind of see both. Multi-monitors are beautiful and come in really great help with these sorts of things, but obviously it's hard to share the screen that way. So you see the top line, everything's the same. Cost of goods sold is in there. I'm going to scroll down here with our expenses. Right here over on the QuickBooks side, we're showing the 12,285.99. If I go to my calculator, and I would typically tie this out on that sheet. If I take the half the meals and entertainment, which is 15,411 times 0.5 plus the 12,285.99, you see that gets me to 19,991, which doesn't quite tie us out there, which is interesting. We looked at it previously. Gets us pretty close. So let's look at some other items here within the return. So page 2, typically don't see this too populated. You'll see our tax liability based upon the income we're showing is 2880. You'll see right now it's not showing anything on the balance sheet. It's because the income is less than 250 and the assets, I believe, are also less than 250. I don't like doing tax returns without showing the balance sheet. I really believe you should use the dual entry accounting and make sure things tie out. So I'm going to force Schedules G's, M1 and M2 to print like we typically do here at our firm. So you will see our balance sheet now. The assets. We'll go through the M1 and the M2, but let me go back and just look for a minute at this P&L. Slide this over here. So got total deductions of 97,502 minus 104,418.29. Sorry, you guys can't see everything I see over here. So we would want to work through and look at this and see line by line here kind of what we have. So we have our advertising 450, auto 13,850, bank service charges, computers 1,800, dues and subscriptions $2,500 for continuing ed. 7658 for insurance. Legal's at 4180. Meals and entertainment 1541. 11. 1428 for supplies. 40,000 for not in payroll processing fees, but salaries and wages down here. Taxes and licenses. Let's see what we got here. 53,112. $2,400. Rent, telephone, $35.98, and travel expenses $54.71. So it looks like we have all the expenses in there correctly. Yeah, so I'd have to look at that. So let's just, it's again still like $700 off there. Oh, and I know what it is. It's depreciation right here. So that depreciation is not accounted for yet on our P&L. We would journal entry that in, and then you'd get your P&L that ties out and is all good to go. So it looks like we are good there. Let's go back to the balance sheet though. And a couple of things, like first, let's go back to the P&L. So, or the balance sheet in the PDF. I would want to get the actual bank statement here and tie it out and make sure it matches up to what's reported on the financials. The other thing I see that I would want to tie out with this company is the payroll expenses. So I would want to see the W-2s, 941s, and 940s, and make sure the payroll expenses and payroll taxes tie out as expected, and put that in part of our work papers. So you'll see here, get back to this and get back to this tab. We have our assets here. We have our bank account assets here, our equipment here. So for this is kicking a partial depreciation. Again, that would be adjusted in, and the journal entry to depreciation expense and accumulated depreciation would then reflect it here on the balance sheet. You'll see we have $50,000 in capital stocks. We have our retained earnings here, 11,497. Net income for the books comes into 19,202. So it's working through the federal tax. It's deducting out half the meals and entertainment here to getting to the 19,202. Now, what you do want to look at with the M2 and the retained earnings is see if these two things balance out. They do not. So you have 11,497. 497 minus 8617. That's 2880. So that's the federal income tax for the books. So for this set of books, this is, as I mentioned, we have it matching the books, and you'll see we have accrual-based accounting here. So we need to reflect that tax liability on the books for the year end. So we'll go back to the balance sheet schedule, and I'll create an other liability and a tax liability of the 2880. Get that pulled back up, and see here now we're at the 8617. We also have the 8617 here because it is now accurately reflecting the liability at the end of the year, which is the tax liability there for federal income tax. And so then we're all balanced out and good and tied out here. So this is really just a good checks and balance for you there and something to look at. As you go with another year here, it'll again just make sure, it's basically checking that, cash in and cash out match on both the balance sheet and the P&L and tying those two things out there. So that kind of, in a nutshell, is basically the major components to the C corporation tax return. You may have a cost of goods sold for our merchant processing there. We have our depreciation schedule here as well. So that's it. Basically gives you an idea of some things relating to C corporations. We really don't see a ton of these here. I don't know, let's say we did between 750 and 1,000 tax returns this year. Probably 10 to 15 will be C corporations at this point. So really don't see a lot of them. They do have some nuances and things with them, but really not also all that different, other than the dividends and double taxation, not all that different from things you would look at and want to tie out with M1 and M2 for either a 1065 or 1120S. So I hope that was helpful today, and I'm sure Andy will be able to jump in on any questions you may have after taking a look at this. Hope you guys have a great week and great weekend, and look forward to seeing you soon here in the near future. Thank you.